we seeing the beginnings of a pause in some of the AI enthusiasm that's really driven an incredible rally. NASDAQ down 0.4% ahead of the open, which might mark, if it lasts, the second straight day of losses after 8 straight weekly gains. We see S&P futures lower by 0.3%. Over in the bond space, you are seeing a bit of yields higher across the board, particularly on the front end, but even on the long end, 3.77% rounded up on the 10-year. A bit of euro strength, but that's really been fluctuating pretty much flat. Crude also flat, trying to get a handle on how to position ahead of a Fed chair who is going to take the helm in the House to try to discuss what the path forward is for Fed policy. One stock to watch at the open certainly is FedEx, certainly following their earnings call yesterday. The shipping giant's fourth quarter sales missed estimates. 2024 forecast also falling short. Executives saying operating results, quote, declined due to lower global volumes, partially offset by decreased expenses and higher U.S. domestic yields. Joining us now, Abigail Doolittle. Abby.
Well, Lisa, yeah, a bit of a messy quarter here, and it, of course, has to do with the fallback coming out of the pandemic, because during the pandemic there was a shipping boom as folks were buying everything online, all of those shipping services needed. Not so much. Now, the company right now is really trying to avoid what they did last year, which was withdraw their full year earnings forecast. So in 2022, the CEO came in and implemented, a new CEO came in and implemented a $4 billion savings plan. That is still the case, and now they're trying to look to save another $2 billion. So they've actually cut 29,000 U.S. jobs over the past year. And as you mentioned, the 2024 profit outlook, you know, it's fallen short of analysts' expectations. Some analysts, including Morgan Stanley, saying that they expect the demand to continue to be weak as folks really aren't buying as much online. The stock, interestingly, is well off of last year's lows, but not surprisingly, it's still off the recent peak by about 26%, as investors are not convinced that this company is quite out of the woods in terms of being able to deal with a normalization of its shipping business coming out of the pandemic. Lisa.
Well said, Abigail. Thank you so much. Sticking with FedEx, Evercore ISI lowering its price target on the stock to $275 from $282. The analyst citing earnings guidance below expectations with, quote, flat to low single-digit revenue growth, representing a cautious macro backdrop. Turning to tech, Microsoft CEO is set to appear in court this week to fight for the company's Activision Blizzard takeover deal. The Federal Trade Commission arguing the acquisition will hurt market competition. Microsoft saying, quote, this deal means more choice for gamers, a fact that only becomes clearer the more you look at the case. Katie Greifeld has more, our preeminent gaming expert. Katie, what do you have?
Big time. Well, Microsoft and Activision, both CEOs heading to court in California this week. The 5-day hearing kicks off in San Francisco tomorrow over, as you said, the FTC's effort to block this $69 billion deal. Just to set the scene here, should this go through, should Microsoft acquire Activision, it would instantly become the third largest game maker in the globe. So as such, you have the FTC arguing that this deal is going to hurt competition, particularly when it comes to console and cloud gaming markets. So in addition to Microsoft CEO Satya Nadella, we're also expected to see both the CFOs of Microsoft and Activision appear in court, and it's unclear when we're actually going to get a ruling. It could come as soon as this hearing wraps up, but remember, the deadline to close this deal is July 18th, so the clock is definitely ticking here, Lisa.
Katie, thank you so much. Turning to electric vehicles, Barclays analysts saying Tesla shares have rallied, quote, too far, too fast, thanks to the AI frenzy and the excitement around its supercharger network. The analyst writing, quote, while we aren't surprised that the stock has participated in the rally, we believe it is prudent to move to the sidelines. Ed Ludlow here with us for more. Ed.
Yeah, good morning, Lisa. Dan Levy calls the rally too sharp. He notes that the May's 24% gain and June's 35% gain were driven by two catalysts, as you note. One, the broader frenzy around artificial intelligence and Tesla's prospects in that respect. And more recently, in the month of June, the domino effect of Ford, General Motors, Rivian, and the charging companies all pivoting to the North American charging standard technology, Tesla's technology for charging. So Dan Levy writes, it's prudent to sit on the sidelines for now. Curiously, though, he raises his price target on the stock to $260 from $220, noting that the factors that comprise their 2030 call and the multiples that they assess this stock on are changing and expanding. In other news, Cars.com has put out its American-made ranking of US vehicles, Lisa, and Tesla's Model Y, Model 3, Model X, and Model S take spots 1 through 4, respectively. It's the second time that's happened. Not doing too much to support the stock. We're down or basically flat, but still trading near September highs.
And still up some gazillion percent so far this year.
Right.
Thank you so much. It's a different story for Spotify. The streaming platform getting an upgrade to outperform by Wolf Research. This as it reportedly plans a new premium tier with high fidelity audio and expanded options for certain subscribers. Sounds expensive and something that my household may end up with. Isabel Lee joining us now with more. Isabel, what's the latest?
Hi, Lisa. This more expensive subscription premium is internally dubbed as the premium. So it's expected to launch this year, at least in non-U.S. markets. So this, of course, is in a bid to improve the revenue of the company as investors appease the company to increase its subscription prices. Profitability has been the name of the game in Spotify. The company has been trying to increase its profits. This year, it reduced its headcount. It also has been letting high-profile podcast deals last and also has been looking to sublease its New York office. Spotify first announced this product in 2021, but it put it on the shelf and delayed the rollback when Amazon Music and Apple Music also launched the same product for free. So that's really fierce competition in that space. Still, there's optimism in the future. Wolf did upgrade Spotify to outperform with a 21% increase in price target, and Bloomberg Intelligence calls the new feature clever. Year-to-date, Spotify has gained around 100%. Lisa.
Isabel, thank you so much. Patrick Fuzzetti of Rose Advisors at Hightower playing defense in this market, writing, quote, expect some pressure in markets the months ahead as the market prices in more rate hikes. Gold has done well during deflationary and inflationary periods where there is sovereign credit risk. I believe we have that risk today. Patrick Fuzzetti, I am so pleased to say, joining us now. Patrick, before we get to gold, and that perhaps it does present the best defensive bet right now, what do you view big tech as defensive, that trade? Do you view that as having any credence?
I really don't, because what's driving big tech today is AI. And you look, it's actually expanded beyond big tech of late, because the number of mentions that artificial intelligence that were never mentioned before by many, many companies is now starting to come up in many calls. And I think we'll hear a lot more about it in this coming earnings season. So I don't give that much credence that, big tech is more defensive, because it's just driven on this recent narrative of AI.
How much, I don't want to say hate, but how much pushback do you get at a time when the market is rallying, when you say you kind of have to be conservative, I'm going to stick with that, look at the flashing signs, this isn't going to end well? How much do you get people calling you and saying, really, are we still doing this?
So I do get pushback, but if you take a longer-term view, I think we can be comfortable. It's not that I avoid all tech. It's just that, I don't subscribe to this narrative that's been, overtaking the market. When the market is very, very top-heavy, right? It's driven by 7 to 10 stocks. That's what's driven all the performance this year. I'm looking at many other signals that I think, create some headwinds for not only the economy but the market, in the coming months.
Like what?
So look, when we think about demand in the economy, so let's not conflate the two things. So I'm going to start with demand. When we look at student loans, those are starting up again. They're right now. They haven't been making payments for the past 3 years. And so those payments can be starting at anywhere from $300. I've seen numbers as high as $500 or $600 a month. That's going to curtail consumer spending. Furthermore, I look at things like new auto sales. The loans on new auto sales now, 17% of new loans are $1,000 or greater per month in terms of payments. So that curtails spending at the end of the day. And I think that that's going to be an issue for the economy in the coming months.
One thing that you noted in your research was a dependence on this idea that rate hikes are going to curtail some of the enthusiasm. And we've been talking all morning about how a significant amount of hikes have been baked into the market actually over the past couple of months. And there hasn't been a response. There hasn't been a sell-off in risk assets. Some people view this as reason to continue to go into risk assets, that they are less susceptible to a sell-off driven by rate hikes. And other people say that, again, it's the ostrich syndrome. Stick your head in the sand. Why do you think that it probably is more the latter than the former?
Well, look, I guess people just don't believe the Fed, perhaps. I mean, the Fed has been very consistent in their messaging, and it sounds like we'll hear more from Powell this week, but it sounds like there will be more interest rate hikes, at least before the end of the year, and I believe them, and so I think that is something that the market has to be prepared for, and it is not pricing in now, and you can see that with this rally in AI, it's pushing it to the side and it's ignoring it, and I think that that's going to be an issue. And that's why, I think you should have an approach where you can be more defensive. It's not to avoid everything. It's not to take no market risk. It's just that you have to be cautious in these times because you cannot time the market.
So let's talk about how you're defensive. How much have you increased your allocation to gold, considering that you view that as one area that will outperform?
Yeah, so we've owned gold now for the past 3 years or so, mainly driven by just thinking about the debasement of the dollar. You own gold because you want to hedge against the debasement of the dollar, or more importantly, and you mentioned this earlier in my notes, that people are worried about sovereign credit risk, and that's the thing that I worry about, and that's why we hold it. We've continued to add gold, throughout the interest rate cycle increasing in early 2022. We've continued to add to it. We still hold a position, and just look at the performance of gold. You wouldn't think that it would go up in the face of rising real interest rates, and that's because there's a fear that there's a sovereign credit risk out there, and that is something that I think is very real.
When you talk about sovereign credit risk, I suspect you're talking about the U.S. in particular, if that's the sort of offset to the dollar. How much are you trying to shift away from the U.S. despite some of the tech rally, especially if you don't believe it can continue?
Well, we have some international exposure, but it's not so much the U.S. I actually think you could have a situation, when you look at the balance of payments across different countries, different economies, I think that could create a sovereign credit issue away from the U.S. And then you could have a big issue. With the U.S., it's the fact that we have to issue $1 trillion after the debt ceiling passed, we have to issue $1 trillion in new debt in the next 3 to 4 months. And that's what's going to create pressure, I think, on the dollar over the next 3 or 4 months.
As you position some sort of allocation strategy that is defensive, still invested, but not defensive, can you talk about the 60-40 concept and how you're either depending on it or throwing it out and kind of betting on a new paradigm?
Yeah, I mean, the 60-40 thing, that's if you think of the 40% as being, long-term bonds, I think you can throw that out. But I think you want to have some balance. You can get a real return now in the bond market, and I think that is something that people should allocate to. We've held some cash, over the last few months as well, and I think that that's also important because you can get a return on cash. But then, having an allocation to stocks, to income-producing real estate, to real assets, that's all going to be very important in the years ahead. Just to summarize it, we've been in a 40-year disinflationary environment. And this inflation that we've been experiencing doesn't go away in the matter of a year or 2 years.
You talk about how longer-term treasuries, for example, is not going to be a ballast for the portfolio. That's a pretty significant shift. How do you then pair that with the idea of real estate, with the idea of all the other instruments that are tied to those longer-term interest rates? Well, with real estate, I think the best real estate investors fixed a lot of their liabilities over the last few years. I think if you were smart, they did that, and so I think you can have some advantage there. But look, anywhere where I think you have long-term interest rate risk, I think will be an issue for investors, I think, in the months, years ahead. Patrick Verzetti, thank you so much for being with us. Really a pleasure to hear your thoughts. Right now, we are about 13 minutes into the open, and we are seeing the softness persist for a second straight day, deeper than yesterday, led by the NASDAQ, actually about the same with the NASDAQ and the S&P, both lower by in and around 3 to 40 basis points lower. Russell 2000 continuing to get less love, and this is going to be one of the big questions as we head toward the second half of the year. How much do we see a broadening out of some of the rally that has really been much more focused on a couple of names? Coming up, Tesla CEO Elon Musk, one of those names, teasing more international expansion, this time in India.
I'm actually incredibly excited about the future of India. I think India has more promise than any large country in the world. I'm tentatively planning to visit India again next year.
That conversation coming up next. From New York, this is Bloomberg.
I am a fan of Modi, so I have to say that. He really cares about India because he's pushing us to make significant investments in India, which it is something that we intend to do, and we're just trying to figure out the right timing.
Tesla CEO Elon Musk meeting with Indian Prime Minister Modi yesterday about potential investment in the world's most populous country. Musk telling reporters, quote, "I'm confident that Tesla will be in India and will do so as soon as humanly possible. It's quite likely that there will be a significant investment, a relationship with India." His meeting with Modi coming after Musk was courted in recent weeks by other world leaders. Bloomberg's Ed Ludlow back with us for more. Ed, it seems like it's the global tour with Elon Musk. Why now?
Yeah. The thing is, the emphasis in that soundbite from Elon Musk, it is Modi pushing for the investments, and that's kind of the commonality in all the meetings that Musk has had with world leaders. They want him in their country, and Musk and Tesla hold their cards close to their chest. As he said in that soundbite, Tesla doesn't want to jump the gun on an announcement, but they do feel they'll make a significant investment in India at some point and be present in India. It's worth noting the Bloomberg reporting on what's happened in the last year. Talks between Tesla and India essentially restarted in May after having been on hold for a year because Musk and Modi's administration had some policy differences on the right way of entering a new market, which maybe we can dig into.
Well, yeah, and I do think that that's important to know. So what is exactly the considerations, especially at a time when the rally in Tesla shares has been one of the significant drivers, frankly, year to date in U.S. equities? I'm just doing the calculation right now, and we have seen a 122% rally in Tesla shares. Ed, what is the frugality? What is the logic between where to expand?
It sounds on that basis like Tesla's not valued as a car company, but it is a car company in the first instance. And so what happened a year ago in May 2022 is Musk was asked why he would enter India or why he hadn't. And he basically said that they will only be in a country where they're allowed to sell and service cars. The Modi administration did not want Tesla importing vehicles from the Shanghai plant. Tesla did not want a heavy tax or levy on those vehicles because India's average household income is different to that of the United States, right? They wanted to test out the market with sort of reasonably priced vehicles that were not amplified by the impact of taxes. The Modi administration kind of went a step further and said, look, you've got to build them here. So now, as Bloomberg's reported, the talks kind of center around local sourcing of components and what that would look like. And it's kind of a chicken and egg situation, but very positive. And you will note, Lisa, that since that meeting last night, both Modi, who is a big tweeter himself, and Elon Musk have tweeted at each other to share their respects after the meeting.
Such a Twitter love fest. Thank you so much. Meanwhile, we are less than 15 minutes, more about 10 minutes away from Fed Chair Jay Powell taking the helm at the House of Representatives in Washington, D.C. Back with us is Michael McKee of Bloomberg. Can you give us a sense of what to expect today versus tomorrow when he heads before the Senate?
Well, today will be the newsmaking day because it's the first day of questioning, and it's the day he delivers his opening statement, which, as we have noted, doesn't contain anything new. But members of Congress will be asking him about basically all the same issues that we'll hear tomorrow in the Senate. Where is inflation going? What's the possibility of recession? And when and if are you going to raise interest rates, and by how much? But the House tends to throw in more political questions as well. I would expect some on the budget deficit. Does he think that the budget deficit's out of control? Do we have to cut spending? Other sort of social policy, fiscal policy questions that, as usual, the Fed chair will decline to answer.
Mike, we talk about the politics of the Fed and how much pushback he might get about the goal of raising unemployment, of really loosening the labor market. How much do we expect to hear that tenor today based on the issue of inflation that still is a preeminent concern?
Well, I would be surprised if we didn't hear about it, but I would expect more tomorrow from the Senate because you have some people who've made that something of a crusade, and I'm thinking of Elizabeth Warren from Massachusetts in particular. She has argued that the Fed set a goal of throwing people out of work instead of just suggesting that unemployment might rise because of interest rates. And so she will probably lecture Chairman Powell again tomorrow, and others may join her in that. But I don't think that it's going to be something that is a major feature of either hearing.
Mike, thanks so much. Let's take a quick look at some of what's getting active in the equity market. Bloomberg's Abigail Doolittle parsing through. Abby, what do you have your eye on?
Well, not surprisingly here, Lisa, with the S&P 500 down for a third day in a row and right now down about 0.4%. Most sectors are lower, led by communication services down nearly 0.9%. We do have two sectors up modestly. Energy up by about 0.3%. Energy up ever so slightly. Let's take a look, though, over the last 4 days because we have the SOX, that chip index, sliding. And this, of course, as you're discussing this possibility that the AI bubble or the AI mania could see some kind of consolidation. Well, they're starting at least.
Abigail, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary. This is Bloomberg. Time now for the Trading Diary. You need to be watching this week. At the top of the hour, Chair Powell testifying before the House Financial Services Committee. Thursday brings the Bank of England rate decision, and Powell said at testimony, Bank of England, very interesting after today's inflation data. We'll also get another round of jobless claims, plus U.S. existing home sales. And Fed speak galore from Waller, Bowman, Mestra, and Barkin. More Fed speak rounds out the week. Friday with Bullard and Bostic. We are, of course, watching for some Fed speak today, including Austin Goolsbee at about 12:30 p.m. today. Right now in the market, you can see a deterioration, particularly led by the NASDAQ, down almost 0.8% as the session grows older. S&P lower by about 0.5%. And the Russell actually doing better than expected. This was Countdown to the Open. This is Bloomberg.
Day like Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, June 21st. Here are the top market stories that we're following for you at this hour. Load up on risk. KKR's Henry McVeigh says U.S. growth will be stronger this year than people think, and investors should add riskier assets. And the Powell play. Fed Chair Jay Powell kicking off his semi-annual testimony to Congress today says higher rates are needed. Stocks and bonds sell off. The two-year yield up by about 5 basis points. And crunch time for the BOE. Core UK inflation comes in hot. Money markets price in a 6% terminal rate by December. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I think it's worth spending a moment to talk about the BOE, and is it a cautionary tale then for the U.S.?
The UK feels very idiosyncratic right now, though I suspect Governor Bailey would rather be in Jay Powell's shoes right now. I appreciate that Jay Powell has got a sort of difficult needle to thread here, but nevertheless, the Bank of England's really up against it. Today's data were horrible. There was nothing really in the numbers to redeem them at all. And the real question now is, how far is the bank going to have to go? And is there a serious risk that later this week tomorrow we do see a 50 basis point hike? The Bank of England looks like it needs to get in front of this.
Yeah, and also, I mean, at least here in the U.S., we can start talking about certain soft landing scenarios, right? Like we're seeing jobless claims come up a little bit, some data softening a little bit, inflation coming down a little bit, but nothing too dramatic yet, versus the UK, where those core and services numbers just keep getting hotter and hotter.
And it is not really, the data are not really being impacted at this point, it seems, by the rate rises that we've seen. Clearly, inflation is going to prove much more intractable. You can maybe see peak rates in the United States. If you take a look at the dot plot, maybe another 2. Maybe we'll get some hints about that today. It'd be interesting to understand what the reaction function is. But the Bank of England, as you say, 6%. What happens at 6%? They thought they'd break the economy at 5%. What happens at 6?
Yeah, Bailey is probably excited. He's not having a presser tomorrow. All right, so let's get to what we're going to expect today from Jay Powell. Bloomberg International Economics and Policy correspondent Michael McKee joins us now. The statement's out. What are some of your biggest takeaways, Mike?
I think one is that Jay Powell's glad he's not Andrew Bailey today. But in general, the Fed has a message. We are still looking to raise interest rates if we need to, but things look reasonably good in the economy, and we haven't decided, and we'll try to figure it out as we go meeting by meeting. That was the basic message in the prepared remarks that the chairman will give, which were essentially a cut and paste of his opening remarks in the news conference last week. And his key line, maybe, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. He talked about the labor market being very tight, inflation well above its longer run 2% goal. They are seeing some effects in interest rate sensitive sectors, but they don't know how those effects are going to play out, which means they go meeting by meeting, which means I suppose there's a possibility they don't raise rates again if all of a sudden we see a big decline in inflation or a big drop off in employment. Yep, dots are pointing us to 2. Mike, stick with us. We're going to be back with Mike in just a moment as we continue to analyze the statement that we've had from Jay Powell and look forward to the hearing on the Hill. Jay Powell yet to sit down. He'll be doing so in the next few minutes. And when we get to what he has to say, we will take that live for you. But let's go to Capitol Hill. Kaylee Lyons is covering this event for us. Kaylee, let's talk a little bit about what the committee is going to want to question Jay Powell about today. We are all going to be focused very much on what he's going to say about the reaction function, about where monetary policy goes from here. But I also look at the statement. It includes a few elements when it comes to the banking crisis. Is that a guide to actually where Jay Powell thinks the questioning is going to come from?
Well, he's going to be asked likely about both of it, especially as in his opening statement that Mike was just running through, he refers to this idea that policymakers may need to hike rates even further. He will likely get some pushback from Democratic lawmakers on this committee about why that is necessary and what economic pain may need to be caused as a result. But on the banking issue, that certainly is one he couldn't realistically avoid either, as the last time he appeared giving testimony like this was just days before Silicon Valley Bank's collapse back in March. And he will likely get questions around supervision, around the idea of capital requirements, what stricter regulation could be coming from the Federal Reserve as a supervisor, as well as just the health of the banking system overall and whether or not the Fed should continually hike rates into it going forward after pausing at this latest meeting. He also may get some more specific questions. Democrats may ask him about housing affordability, for example, and likely there will be some fiscal policy questions thrown at him as well. There always is, even though he says that's your job, not mine, to put it in a paraphrased way. But he could get some questions from Republicans about how maybe a need to pull back spending could actually help the Fed do its job in fighting inflation. There's always a few of those that are thrown at him.
Kayla, we're also showing a board here about President Biden's other Fed nominees. Vice Chair Philip Jefferson, for example, also trying to be confirmed today. Adriana Kugler was going to be replacing Lyle Brainerd, and Governor Lisa Cook to extend her term. Any fireworks we can expect there?
Well, you may see some Republicans on the Senate Banking Committee who are holding that hearing today push the likes of Jefferson and Cook, who of course already have seats on the board, or a bit more of a known quantity, to commit to the fight against inflation, which they did in the opening remarks that we have seen. Adriana Kugler, of course, is a bit of a lesser known quantity, at least in terms of the Fed chair. Of course, she is significant because she would be the first Latina to sit on the Fed board. That is something a member of the committee, Senator Bob Menendez, had really been pushing for. So you could still see some politicking, as always there is in these hearings, a little bit of grandstanding, filming for campaign videos and the likes, but it is the expectation that these nominations should be able to get through the Senate Banking Committee. Of course, that happening today before the Banking Committee hears from Chairman Powell tomorrow. And we are still waiting on Powell, I would remind you, to arrive here at House Financial Services this morning to get this thing going.
He's just sat down, Kaylee. We've had the photographs taken, so we've got a clear shot of him now. And as soon as we get to the main event, we will bring that to you live. Kaylee Lyons joining us from Washington, D.C. At Congress, outside the room. We're ready for that hearing to start. Our question of the day is a fairly straightforward one. Given what we've just heard, what is the Powell play? To try and answer that question, Ira Jersey of Bloomberg Intelligence. Mike is back with us, Mike McKee. Ira, I'm sure you've run the statement through the model. What does it kick out in terms of the tone that we're getting?
Yeah, it actually shows our natural language processing model shows that this semi-annual policy report statement was actually dovish. So it's the first time that we've had a dovish signal from any of our analysis of the Fed statement using that model. That doesn't necessarily mean that the Fed's imminently going to be cutting interest rates, but I think what it does suggest is that there's still this balance of risk is toward, at this point, a little bit more toward slower growth and risk, even if the Fed ultimately does hike one more time, which I don't think that they're going to hike two, and I think Anna Wong at Bloomberg Economics agrees with that sentiment as well, that means that we're definitely quickly approaching the end of the hiking cycle. Mm-hmm. And once we get there, there could be a lot of shifts in the yield curve that are likely to occur.
So, Mike, then to you, what's the Powell play when it comes to making sure that no cuts get priced back in?
Well, I think he would argue his statement's a little more hawkish, and he's going to emphasize the uncertainty that the Fed faces with the economy right now. The question of whether they raise rates, and if they do, when, is going to be a sort of a central question that the House and Senate hopefully will get at. I'm not sure we'll get an answer, but I do think that the Fed basically came out with the hawkish dot plot in order to push the rate cut people out of the Fed funds futures and OIS markets. And at this point, what they're really looking for is a sign of whether they have gone far enough. I don't know that you get a whole lot of data that's going to tell you by the July meeting that things have changed significantly. So they're either going to raise rates because they decided they need to do it to maintain credibility, or they're going to look at the numbers and say, well, we're still making progress, so maybe we wait. Is the Powell play, Mike, just to repeat what he said largely in the press conference a few days back, is the Fed satisfied that the market understands the reaction function that they're working with right now? I'd say halfway. Certainly the market reaction to what they talked about last Wednesday, which is basically his opening statement again, has been in the direction the Fed wants. Markets have priced out rate cuts. They're not going for two at this point, as Ira was pointing out, but they do think the Fed may go one more time. And so that's what the Fed wants the markets to believe for right now and keep as a sort of status quo. However, I don't think that the market really knows what the Fed's going to do, and the Fed may not either. So he may not be completely satisfied with that. But if he can get out of the hearing without committing to anything, that would make everybody at the Fed happy.
This is something that may not make Amazon happy. Here's some breaking news for you. The FTC is suing Amazon for sabotaging consumer efforts to cancel Prime. The case is filed in federal court over in Washington State. A consumer protection lawsuit against Amazon for sabotaging customers' efforts to cancel Prime. The stock down by about 0.7%. Guy, what I find interesting, if we talk about reaction function, if you just take a look at the curve, is the whole curve is, the yields are up by about 5 basis points, right? There's no real delineation between duration and then the short end also. And I wonder if we can glean anything from that, or is this sort of like we're going to sell off in sympathy with what the BOE is going through?
I think there probably was some read across from the Bank of England, and it speaks to a larger problem that central banks are dealing with around the world, which is that inflation is proving much more intractable than we originally anticipated, and as a result of which I think there is some gravitational effect. Ira, is that the right way of looking at the move that we're seeing today? Is the move today that we're seeing in the bond market a reaction to what we've had and are going to get from Jay Powell, or is it a kind of cumulative effect of what we're seeing folding the Bank of England in?
Well, the Bank of England certainly was the impetus for the initial sell-off, and I think that just it was solidified a little bit with Jay Powell's opening remarks for semi-annual policy testimony. The global rates are very highly correlated, particularly among the four large developed markets. So when you have a significant move in Japan or in the UK, then that's going to bleed into U.S. Treasuries. Now, does it persist? It will depend much more on domestic policy and the domestic economy. So I think today's move, 5 basis points in 10-year yield and 2-year yield, is just an acknowledgement, I think, firstly, that yes, the Federal Reserve may hike interest rates a little bit more, but importantly, the fact that you're not seeing significantly more flattening is that maybe the Fed is going to keep interest rates at the peak a little bit longer maybe than the market was originally expecting.
So the long end more mispriced, Ira.
Yeah, I don't know if it's more mispriced necessarily because, once my view has been, and I think will be, and there's always a little bit of wiggle room that you have to give yourself in timing exactly when the Fed's going to end its move and then when it's going to ultimately cut. But once the Fed does start to cut, it's probably, in my view, going to cut much more quickly than the market is anticipating and that most market participants think. So instead of, cutting 25 basis points once a quarter, more likely 50 basis points every meeting for half a year. So that's a couple of 100 basis points lower. That's right where about the 10-year yield is right now. So something like that is not an unreasonable level as far as the long end is concerned.
Ira, you've been talking about this for a while, the fact that when the cuts come, they're either going to be very small or they're going to be very aggressive and come very quickly. Alex, this is really interesting because in some ways that doesn't fit with the part of the statement that Mike read out a little bit earlier on, which talks about the fact that it's going to take a long time to get inflation back down to 2%.
Well, I guess it just means that the pause, or before they cut, will just be very long. So instead of doing it, say, in December, it'll be well into 2024. Mike, what do you think?
Well, you got to remember that the Fed's summary of economic projections that they just put out last week doesn't suggest they get back to 2% until after 2025. So the Fed is going to need to keep rates elevated if that is their actual scenario, and we all know how much the scenarios have changed in short periods of time. But it doesn't suggest that they're going to be super aggressive in the near term. Now, what's the near term? They do think that they will be cutting rates by as much as a full percentage point by the end of 2024. When does that start? How many do they go at a time? I think they would prefer to go slowly. I respect Ira, but I think they would prefer to go slowly because they'd like to find a high enough rate where the economy is in balance, but they don't go down too far because they'd like to keep their options open for cutting rates in the future, get back to something a little more normal, if we could figure out what normal is.
Yeah, but Ira, that really nicely brings us back to the House Financial Services Committee, and that what happens in the last quarter or 2024 is an election. And so it really sets up what the economy looks like, say, in a year from now, that will lead us to a 100 basis point cut.
Yeah, we always talk about the presidential elections and the Federal Reserve, not wanting to upset the political environment around elections. Some work that we've done in the past does suggest that the Federal Reserve starts policy moves, either hikes or cuts, usually before the conventions. So if the Federal Reserve kind of doesn't want to start cuts in, say, September or until after the election, the September meeting is kind of out for the start of any particular interest rate moves that they might do next year. But if they do start cutting, say, once a quarter, and they've already done one or two of them, then they would continue potentially that policy. But it's new ones. The Fed isn't supposed to be a political animal, but it necessarily has to be. I mean, just look where Jay Powell's going to be talking, who they're going to be talking to today. So, and the fact that they are appointed by politicians matters quite a lot as well.
Talking of politicians, We're done with McHenry, we're done with Waters, we're on to Barr, so we'll be moving very shortly on to Jerome Powell. And as I say, we'll bring that to you as he starts speaking. Mike, the other issue is going to be the kind of the issue of what is happening with the banking sector right now. When it comes to the Fed, do they think that issue has now been resolved? Or is there an expectation that it's just a fire that's been tamped down, and as they raise rates, they're going to continue to have to manage that whole issue of financial stability?
Well, I think they would sort of characterize themselves as Smokey the Bear walking around the campfire. It's been tamped down, but they want to make sure it doesn't flare up again. Powell, in his opening statement, did mention banking and suggested that the American banks are in pretty good shape now. They have been expecting credit tightening to impact the economy, but that's what would have happened anyway. And they're not seeing a real issue with the banks. That doesn't mean it can't come back, so they're going to remain wary and keep an eye on things. The questioning from the members will be based on the idea of, A, how did the Fed miss what was going to happen in the banking system when it raised rates so much? And B, what are you going to do about it, and why haven't you done it already?
Well, that raises the question too, Ira. Is it a done deal that we need to actually get a kind of credit crunch? Like, I know the theory, but CRE is not falling out of bed. It's very pocketed, right? Like, commercial and industrial loans are holding up. I mean, that doesn't signify sort of an imminent credit tightening cycle.
Yeah, so far you haven't seen necessarily loan balances start to decline, right? So you haven't seen this credit contraction yet, but you have seen second derivatives slow. So lending in general is slowing a little bit, but not falling off a cliff. So I think that's a good point, Alex. So something else related to banks that I think, though, is something I'm going to be listening for Jay Powell, because he's going to be asked about the balance sheet. Mm-hmm. He's going to be asked about asset runoff. And, by our calculations, come February 2024, the bank reserves are going to be at the level where you wind up getting some issues in the funding market. So that's similar to what happened in, say, September 2019. So I'm going to be very focused on how he responds to that, how far they're going to allow the balance sheet to run off. And we know that there's some members that definitely want the balance sheet to be much smaller.
Guys, really appreciate it. Thanks a lot. Mike McKee, Ira Jersey, really appreciate you helping us get to here, because Fed Chair Jay Powell is now reading his prepared remarks at the House Financial Services Committee. Let's listen.
Committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve, and without it, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 5 months of the year, job gains averaged a robust 314,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total personal consumption expenditures prices rose 4.4%. Excluding the volatile food and energy categories, core PCE prices rose 4.7%. In May, the 12-month change in the CPI came in at 4.0%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. With inflation running well above our longer run goal of 2% and with labor market conditions remaining tight, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5 percentage points since early last year and have continued to reduce our securities holdings at a brisk pace. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. And the extent of these effects remains uncertain. In light of how far we have come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the FOMC decided last week to maintain the target range for the federal funds rate at 5 to 5.25% and to continue the process of significantly reducing our securities holdings. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, we will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and inflation economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability, again, is essential to set the stage for achieving maximum employment and stable prices over the longer run. Before concluding, let me briefly address the condition of the banking sector. The U.S. banking system is sound and resilient. As detailed in the box on financial stability in the Monetary Policy Report, the Fed, together with the Treasury and the FDIC, took decisive action in March to protect the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including that of Silicon Valley Bank and the resulting bank stress, have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We are committed to addressing these vulnerabilities to make for a stronger and more resilient banking system. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman. I now recognize myself for 5 minutes. Chairman Powell, as I laid out in my opening statement, inflation continues to be broad-based and persistent, both of which are concerning. Last week, the Federal Open Markets Committee decided to pause rate increases. And at the same time, the committee alluded that it would raise rates more later in the year. And so how should the FOMC's posture at the June meeting be interpreted? Will the committee continue to raise rates later this year? What's the thinking of this? What are we to understand?
Thank you, Mr. Chairman. So you're right, of course. We did decide to maintain the federal funds rate at its current rate at this meeting. At the same time, participants submitted personal forecasts suggesting that almost all of them thought there would be additional hikes. And I just want to say those two things are entirely consistent. The point being that the level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. That's really it. You know, We were at 75 basis points for several meetings, then we were at 50 basis points, then 50 basis points, 25 basis points at 3 consecutive meetings, and now we're monitoring that pace, much as you might do if you were to be driving 75 miles an hour on the highway, then 50 miles an hour on a local highway, and then as you get closer to your destination, as you try to find that destination, you slow down even further.
Okay. So it is more data is necessary for the Fed to make these decisions, and that's one interpretation, but thank you for a broader view there. I also want a broader view on this question of the Vice Chair for Supervision is performing his own personal holistic review of the Fed's regulatory framework for bank capital and liquidity. In an interview yesterday, he discussed some version of a new type of stress test even, striking complete confusion in his description of it. And at the same time, we have testimony from you, even from the Vice Chair of Supervision, saying that we have a sound banking system that is well capitalized. You will sit in judgment of this proposal that the Vice Chair for Supervision will bring to the full board on this holistic review of capital. There are a lot of discussions about the amounts of capital he's talking about, the concern that this is pro-cyclical at a time where our economy with higher rates is you're measuring what's happening in the broader economy, and at the same time we're going to have a major piece of capital required by financial institutions, which will further restrict lending. So how can you tell us to think about that, given your seat on the Open Markets Committee and as a Fed governor? How would you interpret that?
So I guess I would say you're right. There are a significant number of proposals that are kind of in the works. They haven't been finalized, let alone brought to the board yet. And so I can't really get into specific details today.
Well, we like your thinking, Chairman Powell. That's what we like.
What I can share is, principles and how I will think about this. Regulatory proposals go to the board. Every person on the board, that's 6 governors now, has an obligation to evaluate and vote on those, and I'm one of those people. I also chair the board. So a couple things I would point out. Just first that, I think regulation should be transparent and consistent and not too volatile, and particularly as it relates to capital requirements. I do note the central importance of capital. We want banks to be resilient to shocks. We want them to be able to lend in good and bad times. We want, in particular, the GSIBs, the 8 largest banks, to have high levels, very high levels of capital and liquidity. Indeed, we spent years raising those levels over a long period of time. And I think there's broad agreement, as you point out, that capital is strong. And, the question there would be what sorts of increases will be justified. That's what we'll be looking at. The other thing is to point out the trade-off between higher capital. The benefit of it, of course, is to have stronger banks that can lend and maybe survive more kinds of crisis environments. But, there are costs as well. And I think it's going to be, as always, a question of weighing and balancing those costs. And that's what I'll be thinking about. The last thing I'll say about that is just we benefit from having banks of all different shapes and sizes in our system. And we want to be careful not to regulate the smaller banks to the point where really their business models are challenged for all but the largest banks.
Well, this committee would expect to see a quantitative analysis of whatever the capital charge is going to be. We would expect that from the Fed, as we do from other regulators. With that, we'll now recognize the ranking member of the full committee, Ms. Waters, for 5 minutes.
Thank you very much. Chair Powell, at this committee's last hearing on digital assets, my Republican colleagues proposed a stablecoin bill that would create 58 different licenses with federal regulatory approval over only 2 of the licenses. The remaining 56 licenses can be issued by each state, territory, and D.C. with little or no federal oversight, regulation, and enforcement. This proposal takes state preemption into a whole new level. It effectively allows every state to preempt another state. DC-based coins, for example, would be sold to individuals nationwide, and New York or North Carolina regulators could do nothing to protect their own residents, while even the Fed would be severely hamstrung in providing any oversight. I've argued that we should allow states to be part of this process, but we must have a strong, enforceable federal floor with a role for the Federal Reserve to approve and provide oversight of payment stablecoins issued by non-banks in order to ensure that consumers are protected. Such a framework is similar to our dual banking system, and it would ensure that non-banks and banks are treated the same. We should also bear in mind that payment stablecoins are a new form of currency intended to allow individuals to pay for things with them. As such, do you agree that it is important for the Fed, as our central bank, to have a chance to approve or decline any state licensed non-bank entity before it starts issuing payment stablecoins nationwide?
Well, first of all, let me say we appreciate that we've been able to offer our views on these things to your staff and also the majority staff, and we appreciate the consideration that's given to our views. We do see payment stablecoins as a form of money, and in all advanced economies, the ultimate source of credibility in money is the central bank, and we believe that it would be appropriate to have quite a robust federal role in what happens in stablecoins going forward, and that leaving us with a weak role and allowing a lot of private money creation at the state level would be a mistake. But nonetheless, again, I do appreciate that we've been able to be heard and share our views with the committee.
Well, thank you so very much. I am appreciative for that clear answer. The next question that I have for you is a bit unusual. But one of the reasons we push diversity is because those things that have not been discussed, issues of people of color, etc., have not been dealt with. I'm going to throw you something that you would not expect. Earlier this week, our nation celebrated Juneteenth, which Congress recognized as a national holiday for the first time since 2021. The holiday celebrates the day enslaved African Americans in Texas heard that they were free, 2.5 years after the Emancipation Proclamation was issued. To this day, Black Americans grapple with enduring racial economic inequality that has its roots in slavery, as evidenced by the black-white gap in net worth and home ownership rates. My bill, the Federal Reserve Racial and Economic Equity Act, would require the Federal Reserve to carry out its duties in a manner that supports the elimination of racial and ethnic disparities in employment, income, wealth, and access to affordable credit. Now, the Fed has a number of duties to pursue maximum employment in the monetary policy, to supervise banks for compliance with our fair lending laws, and to ensure the Community Reinvestment Act is administered in a way that puts an end to discriminatory redlining practices by banks. Do you agree with me? And Atlanta, Federal Reserve President Raphael Bostic, among others, that the Fed has a role to play in addressing racial economic inequality as it carries out its work until Congress passes this bill. What steps will the Fed can you take to address racial and economic inequality?
So we do consider inequality in the economy as part of our thinking about decisions, but ultimately, and those are certainly highly valuable social goals to pursue. I would say our ability to take part in addressing those issues is fairly limited. We have one federal interest rate that we set. We do try to keep in mind, as you know, not just the aggregate national level of unemployment or employment, but also that for different ethnic groups. So we take that into account, but I would think, and I think that's just part of making sure that we feel like we have all Americans in the room with us when we're making decisions on monetary policy. I will say, though, I think other agencies are better suited to address these deep issues.
Thank you. We must have this continued discussion on racial equality. I yield back.
The lady yields back. We'll now go to the Vice Chair, Mr. Hill of Arkansas, for 5 minutes.
I thank the Chairman of the committee, and Chairman Powell, great to have you back before the committee. And this morning, you reiterated, and certainly Vice Chair Barr has reiterated a number of times, that the banking industry here in the United States is well capitalized. And in fact, capital levels have remained robust despite COVID-19, with a 20% plus unemployment rate increase and a 9% output gap. They've remained stable through government shutdowns. They've remained stable through severe stress testing. And maybe more importantly, just in the last few months, since the first week of March, you've seen strong capital come into play as we've grappled with the reality of a 40-year increase in short-term interest rates and that impact on banks. But as the chairman said, Michael Barr continues to say he wants to increase capital requirements on certain financial institutions. And in March, you testified that you said, I will do everything I can possibly do to bring people together, meaning on the Board of Governors, in consensus and have a capital framework that could be broadly supported. So to what extent have you and the other governors been involved in this so-called holistic review by Vice Chair Barr? Has he briefed the other members of the Board of Governors thus far?
Yes, and we've all been briefed by staff, really, on the proposals, but as I mentioned, they're still somewhat in motion. But yes, we've been briefed.
So you would say those proposals are still under consideration and that there's no final decision that's been taken by the board?
No, well, no. Once the proposals really do settle down and are written up, they'll come to the board for a full discussion and a vote.
Has the Fed board reconstituted now the Committee on Supervision and Regulation? The membership of it?
Oh,
who's on that committee now?
So that committee is chaired by Vice Chair Barr, and it also includes Governor Jefferson, and it includes Governor Bowman.
When you look at capital in the U.S., and I look at the globally significant banks here versus other places in the world, would you say that the U.S. banks, the U.S. G-SIBs, are better capitalized than their global peers in Europe or in Asia?
So we're certainly at or near the top of the league table. I think there are a couple other jurisdictions that also have broadly similar levels of capital strength. But yes, we're at the top of the league table.
I looked at it this morning, and the U.S. G-SIBs have 11.3% capital without any kind of modification compared to their European competitors at only 9.9%. So would you say that we're better capitalized than the European banks, the European G-SIBs?
I hate to call out the other jurisdictions, but I would say our banks are very strongly capitalized and also competing quite successfully globally outside the United States.
Yeah, I agree, and I think we've strengthened capital, we've strengthened our supervision, notwithstanding the problems that we saw this spring, which we've talked about ad nauseum here. But that capital standard does make American banks, I think, stand out. And wouldn't Basel, the so-called Basel III holistic reforms, wouldn't it be better if the European banks did a holistic review and actually got their capital up to American standards?
So I think they are bound by the same, no one's bound by these, but they have agreed to follow the same standards, and I think they're going through the same process we're going through.
Same topic, are the FDIC supervisory process and the OCC supervisors, are they involved and engaged with Vice Chair Barr in looking at this, quote, holistic review of capital adequacy?
I think,
in other words, are they providing their input to the Vice Chair for supervision in their own views on this topic?
On the regulatory proposals that are relevant to them, yes. I think on the capital proposals, yes, I believe so.
And you made a comment a minute ago, I think, to Chairman McHenry's questions about that you'd like to see rules and supervisory rules consistent over time. And I think that's frustrating here. We see change in administration. Sometimes we see change in rules, which is, I think, frustrating to the private sector and to market participants. I note that the Biden administration says that the Financial Stability Oversight Board should now base their decisions on size as opposed to activities. And for several years now, we've had an activities designation and a cost-benefit analysis. Do you think the activities designation gives supervisors more discretion at FSOC to select who should be deemed under their supervision?
So I actually think that
in other words, is size alone, should we be looking only at size, or should we look at cost-benefit analysis and activities? And my time's expired. If you'd answer in writing, I would appreciate it. I think this is an important issue. I yield back, Mr. Chairman.
We'll now go to Ms. Velasquez of New York for 5 minutes.
Thank you, Mr. Chairman. Chair Powell, at your press conference last week, you stated, and I quote, "The committee is completely unified in the need to get inflation down to 2% and will do whatever it takes to get it down to 2% over time." Some analysts have interpreted this statement as the FOMC's willingness to trigger a recession in order to get inflation to 2%. How would you respond if this is a fair and accurate interpretation?
So our statutory goals are price stability and maximum employment, and we are dedicated to using our tools to achieving those. In the case of employment, we still have historically low unemployment rates and high employment rates now, high participation, a very strong labor market. We're very far from our inflation target of 2%, and we're very focused on getting back to 2%.
And how does the FOMC takes into consideration the impact of rising interest rates on LMI communities and small businesses when determining monetary policies?
So we only have one interest rate to raise or lower. It's not true, but mainly one main interest rate to raise or lower, and it applies to everyone. But I would say that inflation hits LMI communities and people generally at the lower end of the income spectrum much harder than people in the middle or at the high end, because high inflation can get you into trouble right away if you're living on a fixed income just to cover the basic necessities. So it is for the benefit of those people that we must get inflation under control. It's for the benefit of all Americans, but particularly for those people. And we keep that in mind as we are strongly committed to getting inflation back down to 2% over time.
Well, and they are the same people that are having a hard time accessing loans. The same with small businesses. Chair Powell, Vice Chair Barr's report on the Fed's review of Silicon Valley Bank states that while there was regulatory tailoring conducted in response to S2155, there was also, and this is the part that really concerns me, a cultural shift at the Fed under the direction of the previous Vice Chair for Supervision, Randy Quarles. According to the report, this shift included pressure to reduce burdens on firms, meet a higher burden of proof for a supervisory conclusion, and a need to accumulate more evidence than in the past. As chair during that period, were you aware of this cultural shift and the impact it was creating?
So I think we learned from the Silicon Valley failure and the others that there is going to be a need for stronger supervision and also regulation for banks of that size. And I'm committed to learning the right lessons from this exercise and to forthrightly implementing changes.
Were you aware of the cultural shift?
So I can't really characterize it that way. Certainly, I was aware that we were trying to avoid excessive regulatory burden. That
so
is
you
always
disagree with Chair Barr's report in that respect?
I'm sure that the people who wrote the report were accurately reporting what they heard from back in the day.
How often were you meeting with Vice Chair Quarles?
I reasonably frequently. We sat quite near each other.
And never discussed the cultural shift.
I didn't say that, but I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall.
Well.
So what
I had no part in. I said I had no part in preparing the report. I'm confident that the staff who worked on the report reported accurately what they heard. I'm sure that that's right.
So what steps did you take proactively to meet with regulatory and supervisory staff?
Well, I think we're taking significant steps now. We're, as you know, under Vice Chair Barr's leadership, we're looking carefully at these events and asking ourselves, what do we need to do with supervision? And I think there is a point to be made that There are situations in which we need to be more forceful and more proactive, not in all situations, but in some. In regulation, I think we're learning that we need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated.
My time has expired. The gentlelady's time has expired. We'll now recognize the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. I just want to start off by asking a few yes or no questions. Was the Silicon Valley Bank failure a result of a liquidity issue?
I'm sorry.
Was Silicon Valley Bank failure a result of the liquidity issue?
Among other things, yes.
Signature Bank failure, the result of a liquidity issue?
Yes, I mean, that's not, there's also a lot of very bad management decisions being made here.
But liquidity. First Republic, was that a failure result of a liquidity issue also?
Among other things, yeah. I mean, I wouldn't say just liquidity.
Well, all right. Were any of them a failure of having too low capital levels?
So let's go to Silicon Valley Bank. You know, the issue that triggered the run initially was the presence of significant losses in their securities portfolio.
Yes.
And that is that is a capital issue.
So they had too low a capital? The requirements,
They weren't required to, as you know, they weren't required to take that into account in their capital. But I think if you remember what people were focusing on was these portfolio losses, and then what people weren't focusing on was the fact that they had in excess of 90% uninsured deposits, and that's what caused the run.
So would increasing capital requirements for Silicon Valley Bank or any of these other banks or all banks together, would that have stopped these banks from failing?
That's a hypothetical, unknowable question. I think it might have helped. I think it might have helped, but
how much then? Increasing it by how much would have helped?
It's very hard to say. Very hard to say. I mean, clearly the main issue there was a failure of management to follow up, a failure of supervision to require them to follow up, and really the liquidity regulation was just not. It was not appropriate. We needed to have stronger regulation around liquidity and uninsured deposits.
So last year you said the banking system is very strong, well capitalized, highly liquid, does a much better job of understanding the risks that it runs and managing them. And just today you said the banking sector seems to be strong. Do you still stand by those statements? I mean, you just said it today.
Yes.
So, yep. And last month, Vice Chair Barr appeared before this committee and he agreed with you and said overall banks have a strong capital and liquidity. Secretary Yellen has said similar things. But today even though you've all said that banks seem to have strong capital, you seem to lead us today by saying the bank's considering what increase would be appropriate of capital requirements. So has the board already decided that an increase will happen? They're just deciding what's the size of the increase for capital requirements?
No. What I meant to say, what I thought I said was that any increase above these levels would need to be shown to be justified.
So I understand. And you have a vote as whether or not what this proposal, you'll vote on whether or not. Do you personally think that an increase is necessary at this time?
Do I think?
That an increase in capital requirements is necessary at this time?
Look, I'm going to react to whatever the proposal turns out to be in the end and give it my best assessment. And also, that's what I'll say.
Okay. You just also said that credit is tightening. Won't increasing capital requirements further tighten credit?
Over time, I mean, the thing about capital requirements is if we put a proposal out this summer, let's say, it'll be quite a while before that proposal is, agreed among the agencies and then voted on, and then it'll take some years to come into full effect. So I would think, whereas interest rates, for example, have immediate effects on financial conditions and then reasonably quick effects on economic activity, capital requirements are a much more sort of medium-term, longer-term thing.
So I'd like to move on to what the impacts on raising capital requirements would have. According to an academic literature by the Basel Committee on Banking Supervision, a 1% point increase in capital requirements could potentially reduce annual GDP by up to 16 basis points, showing that higher capital requirements come at a cost and could have significant impact on the U.S. economy. I discussed this with Vice Chair Barr last month and expressed my concerns about what the impact of increased capital on the real economy, but he didn't answer the question directly. We just need to, we're hearing from all sorts of industry that these increased capital requirements at any level would have a further tightening on lending. And if that happens, and I'm hearing from everybody, if that happens, it's going to be a real disaster. So I think anything that the committee proposes, if you could come back and brief us on before it's finalized, we would appreciate that very much, sir.
Gentleman's time has expired. The gentleman from Missouri, Mr. Cleaver, is now recognized.
Thank you, Mr. Chairman. Welcome, Mr. Chairman. Thank you very much. This is probably Economics 101, but a lot of people in my district are misunderstanding 101 along with me. In May of this year, unemployment remained at 4% for the 16th consecutive month, and at 3.7%. This means that unemployment remained at or below 4% for the longest stretch in 50 years. In the U.S., the job openings rate has fallen by more than 1.5 percentage points from its peak, while the unemployment rate has crept slightly lower. In other words, the job openings decline, but so does joblessness. And I'm wondering if there was any expectation that this would occur.
There is an expectation that the level of the ratio of job openings to unemployed people has been in historic territory, all-time highs for a while now, in the last year or so. And there is an expectation that it will come down. There a while ago, there were 2 jobs for every unemployed person. Now we're down to 1.7, I believe, or 1.6. And that still speaks to a historically tight labor market, where their demand for labor still very substantially exceeds the supply of available workers. So we do expect as things, and that, by the way, that's a way that the labor market can become less tight without having unemployment go up.
I'm sure you're hearing this all over, as I am, and that is business people. I've got a good friend who has number of barbecue restaurants in Kansas City, and he is constantly telling me how difficult it is to find workers, to the point where he did something he thought I'd never do, put a sign out in front of his restaurants, job openings. And are there particular industries or sectors of the economy where we would expect this sentiment to be particularly true?
No, and that is right. That is, there's still a significant labor shortage. The surveys at the aggregate level show that it's not as bad as it was 2 years ago. So gradually, businesses are reporting that they're having better able to find workers. Workers are reporting that they're not quitting their jobs as much as they were. That's a really good sign of how tight a labor market is how much people feel free to quit their jobs voluntarily. So those things are all suggesting a gradual cooling and a gradually getting supply and demand back into alignment. But we're not there yet. We still have a significant excess of demand over supply.
Are we also finding that I know in Missouri, that in spite of the fact that there is some, jelly-like movement with the economy, people are still willing to go, in our community, still willing to go out and buy homes. I mean, we're not having difficulty in terms of people going out getting loans, even with the interest rates rising. If all of this continues, if the consumers are constantly paying whatever the interest rates might be, are we going to get stuck just continually going up?
Well, no, I don't think so. So in housing in particular, there is the housing sector nationally has flattened out and maybe ticked up a little bit, but at a much lower level from where it was with rates as high as they are. So supply and demand there are getting back into alignment. And I do think that, housing inflation is set to come down as we move forward. There's a particular way that the inflation is calculated there, so that you're really only looking at you're waiting for leases to come due and roll over at much lower levels of increase. So we think housing inflation will be coming down significantly over the course of the rest of this year and next year.
Thank you, Mr. Chairman.
Gentleman's time has expired. The gentleman from California, Ms. Kim, is recognized.
Thank you for recognizing me, Chairman. And Chairman Powell, thank you for joining us. I appreciate your comment to price stability and commend your efforts to reduce inflation and make life more affordable for all Americans. Thank you for that. The 10,000 small businesses survey of 2,000 small businesses found that 77% were concerned about their ability to access capital. So with that in mind, do you think it's appropriate for the Federal Reserve to increase capital requirements at this time? And I know this was discussed earlier, but what specific analysis has the Fed conducted so we can determine the impact of this warrantless regulatory action on small businesses and other marginal borrowers?
So with capital standards, it's always a trade-off. The more capital means a more stable, more sound, more resilient banking system, but it also at the margin can mean a little bit less credit availability, and also the price of credit can be affected. And there's no perfect way to assess that balance. Obviously, the answer is not zero capital, and it's not 100% capital, so it's somewhere in the middle.
Thank you. There are estimated about 1.5 trillion of commercial real estate loans that are maturing in the next 3 years. And declining demand and the prevalence of work from home policies are putting a strain on commercial real estate market. The bulk of commercial real estate loans are held by smaller and regional banks. So is the Fed thinking about policies that could provide time for commercial real estate loans to be refinanced? And could an increase in capital requirements reduce liquidity in the commercial real estate loan market?
So we're very focused on the commercial real estate situation. You're right, of course, that a good portion of the commercial real estate loans are held in smaller banks. And supervisors are very much engaged with those banks. And it's particularly banks that have a high concentration. That's what we look for among the smaller banks. And there are some of those. But there's a playbook for working your way, working your way out of these loans. And it's particularly in the office sector where, work from home is still a pretty material factor in some areas, as you know.
Thank you. So the next question has to do with the board process and procedures. What are those procedures that govern consideration and potential adoption of matters like the proposals that Vice Chair Barr is, about to present to the board?
So on regulation, as opposed to supervision, on regulation, the Board of Governors votes on regulatory proposals, and it's a majority vote. We now have 6 voters, so when there is a proposal, it will be briefed carefully, and then we will have we'll have a meeting, or it can be done actually virtually, and probably will be that way, as most of our meetings are, and then we have a vote. On supervision, it's different. Most supervisory matters are really under the authority of the Vice Chair for Supervision under the law. So most of them don't have to go to the board for a vote.
So what percentage of the governors must vote in favor?
Majority.
The majority of them? Okay. Yeah. The California governor, prior to the depositor bailout for SVB, reportedly identified that he had been in touch with the highest levels of leadership at the White House and the Treasury. The governor also on Sunday, March 12, when the bailout was announced, issued his own statement praising that action. There have also been reports that the governor and his wife with respect to their business and perhaps other interests may have had depository interest in SVB. So when the Federal Reserve Board, the FDIC Board, and Secretary Yellen, in consultation with the President, recommended invoking the systemic risk exception for SVB, and then decided to provide blanket insurance even on uninsured balances, did the Fed or any others, to your knowledge, perform any conflict of interest due diligence?
No, I mean, we were in an emergency situation on Monday morning that was going to be, and there was a run on banks that looked, that
So
had
looking back, do you think there was
we carried out our duties, and I'm actually pretty sure we did the right thing.
And you don't think there was any conflict of interest, even looking back?
I have nothing. I have absolutely no knowledge on that.
Okay. Well, thank you. Thanks for being here. I yield back the balance of my time.
Gentlelady yields back. The gentleman from Texas, Mr. Gonzalez, is recognized.
Thank you, Mr. Chairman and Ranking Member. Thank you, Chairman, for being here with us this morning. The June Federal Open Market Committee report indicates inflation in the U.S. and abroad continue to ease but remain elevated. In response to the FOMC that has the proposed interest rate increases up until June 14th, recommendations to pause interest rate hikes for the first time this year, research has shown that the effects of monetary policy decisions, like raising interest rates, can take on average 42 months to be realized fully in the United States, meaning we may not fully understand the effects of this first increase in rates of March 2022 until next fall. With that in mind, how have our recent tightened monetary policies impacted the strength of the U.S. dollar and how it is valued globally?
Let me say that there's a lot of uncertainty around how long it takes monetary policy to affect real activity. There's no agreement on 42 months or any particular thing, and I think most people would say shorter than that. So you're asking how it would affect the dollar?
Yes.
So first of all, the Treasury Department has a responsibility for the level of the dollar and the stewardship of the dollar as a currency. We don't actually comment on that. We don't look at any particular level. It's just to us, it's a financial condition. A stronger dollar means certain things, and a weaker dollar means certain other things. But
it continues to be a concern here in this committee. Also, Chairman, as you're aware, the Federal Reserve's core mission is to keep employment up and inflation down. Although I understand the calls for climate-related financial risk management from my colleagues, we should be focusing on the economic state of our country. The credit of the U.S. dollar is at jeopardy, and as you know, we've had global pressure recently, and we need to be sending a clear message that the world can rely on the full faith and credit of the United States dollar. We should be focusing on mitigating the calls to reduce dependency of the U.S. dollar. Monetary policy changes implemented in the U.S. are likely to cause a ripple effect throughout the global economy. With that said, would you agree that monetary policies to directly address climate change should be made by Congress and not the Federal Reserve? And implementing monetary policies and supervisory tools to exclude energy leaders from capital and financial institutions would have a grave impact on local, state, federal, and even global economies?
A strong agreement around the fact that we have quite a narrow role in climate change, and really the important decisions about climate change need to be made by elected people, not by the Fed.
Thank you, and I yield back.
Gentleman yields back. The gentleman from Florida, Mr. Donalds, is recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Really appreciate you being here. Look, I got to say, first of all, it was good to hear from the other side of the aisle that the Federal Reserve should not even be engaging in using its tools with respect to climate change or climate mitigation or whatever the case might be. The Fed, you guys have a big enough job as is. Adding anything like that to your job, I think will be wholly detrimental to the American economy. So I, for one, this morning am glad to hear that coming from the other side of the aisle. You've had a couple questions already on capital, bank capital, et cetera. look, some of the current views are that continuous raises of bank capital will increase costs to our economy anywhere from $50 to $200 billion. What's your view of the current desire or mode of Vice Chair Barr to fully implement the Basel III capital standards?
Well, I think that's the next thing. Vice Chair Quarles was working on that. It didn't get completed for various reasons, but that, I think that's an international capital standard that we should go ahead and complete. As to the right level of capital, that's a discussion we're about to have.
Are you guys at the Fed, are you guys kind of concerned about the fact that now it seems like the European regulators are starting to pull back from that? Like they're starting to think about capital standards being too much for European banks, and that they're starting to recede from what was, I assume, kind of a handshake agreement in years gone by?
Yeah, I'm not hearing that exactly. We'll be watching that carefully, though.
Okay. Overall, just with respect to capital, let's take a step back. Obviously, since 2008, 2009, we have, in my view, aggressively gone through this process of increasing capital standards and capital requirements on Tier 1 capital for banks. In retrospect, do you think that's been a net positive to the overall banking environment, or do you believe it's been a negative to the overall banking environment?
I think it's been a net positive, and as I pointed out earlier, U.S. banks have competed very, very successfully through this period, despite what were pretty significant capital increases that we put in a few years back. So it really has led to a very strong, and also made it well through the pandemic period, I thought, and I think that was a pretty good test. So even though the government did do a lot to support the economy, still, I think that those capital hikes that we made in the last cycle come through looking pretty good.
Do you guys at the Fed, do you have a view of, I say you guys because I know you're the chairman, but there's other members as well. Do you have a view of the concern about community banking in the United States, or a lack thereof of community banking? It has been shrinking quite significantly over the past 10 to 12 years.
Very, very much so. It's a focus for us. We understand the importance of community banks, that they provide a different service and a really important service to smaller businesses and communities. And community banks have been consolidating for 30 years now. So it's really a secular trend as people have moved to bigger cities and things like that. But we don't want to do anything to move that along. We think that the world's not a better place with fewer community banks, and we try to keep that in mind in all of the regulatory and supervisory things that we do.
Do you think that federal regulatory policy, in part from Congress, has led to a supercharging effect of diminished community banking in the United States?
It's probably been a factor, but I do think there have been important demographic factors as well. And also having interstate banking. Interstate banking only became legal quite recently, and that also has led to consolidation. You can look back, though, look back 30 plus years, and you've seen a very steady decline. So I think there are demographic and other factors driving it, but regulation can fall as a fixed cost, which means that institutions need to be bigger, and I think that's probably part of the story.
Look, I don't disagree with your conclusion. I'm just concerned about the trajectory. I think just having larger financial institutions, larger banks overall, with a diminishing smaller community bank infrastructure is detrimental to lending to small businesses, mom and pop businesses. It also could be parochial. I started my career in community banking, so I saw a heartfelt situation. Last question, running out of time. The SEC has proposed a rule that would, among other things, require banks to segregate client cash held in custody, upending custody bank balance sheets, and by extension, the bank custody model. Are you guys at the Fed concerned about this proposed rule from the SEC?
The gentleman's time has expired. The chairman can
respond to that.
Writing.
Okay, fair enough. Thank you, Mr. Chairman.
The gentleman from New York, Mr. Torres, is now recognized.
Thank you, Mr. Chair, and thank you, Chairman Powell. As you know, the U.S. has foreign adversaries, particularly the CCP, that seem intent on de-dollarization. How seriously should the threat of de-dollarization be taken, in your view?
Well, the status of the United States, of the dollar as the world's reserve currency, is a very important thing to us. I think The reason we have that status is largely due to our great democratic institutions, the rule of law, and the fact that we have, generally speaking, had strong levels of price stability. And I think that the dollar will remain the reserve currency as long as those things are in place.
Well, I want to explore that answer because commentators often speak of the dollar as the world's reserve currency as the cause of America's economic dominance. Do you think of it as the cause of America's economic dominance or as a consequence of it?
To me, it's more of a consequence. And also, there tends to be an equilibrium where one currency becomes the accepted global standard, and that has been the dollar for some time, and I expect that it will be for some time, continue to be.
It's often said that the Fed has a dual mandate of maximum employment and price stability. Do you view these mandates as equally binding upon the Fed, or does one supersede the other?
They are perfectly equal under the law.
And I'm curious to know what it means in practice to have a 2% inflation target. The latest pause notwithstanding, does it mean the Federal Reserve will continue raising interest rates until the 2% target is reached, even if doing so comes at the expense of maximum employment as well as financial stability?
No, it doesn't mean that. It does not. So the way we think about it is most of the time the two goals are aligned in the sense that if you're achieving one, you're achieving the other, and if you're a little bit off, the other one, they move in the same direction. Today's situation is unusual in that we are overachieving, in effect, the maximum employment goal, but we are far from achieving the inflation goal. So in our system, we have a constitutional document, and what it says is that when that's the case, you look at how far you are from the goal, and you look at the speed with which you would move back to the goal. And so that would tell you today that we should focus heavily on inflation, but as it becomes closer, as the two things become more aligned, then they go back into perfect equality under the law.
So the Fed engages in a delicate balancing act between employment and inflation.
Yes.
To what extent do you factor in financial stability, safety and soundness when raising interest rates?
So you're right. We do have a financial stability mandate, but we try to.
Well, you have a financial stability mandate with respect to your role as a bank regulator. But when it comes to
also just generally, we're the lender of last resort. Central banks were originally created to support the financial system in times of stress and to make sure that you don't get into times of stress. So I would say that, sorry, what was your question before that? It was
to what extent do you factor in safety and soundness when setting interest rates?
Sorry. So we really try hard to use our financial stability tools for financial stability purposes and our monetary policy tools for monetary purposes. The reality on the ground is much messier than that. They're very much entangled, and one affects the other. So the separation is not at all perfect. But we do think of these as separate things with separate tools.
Do you think that the Silicon Valley bank failure revealed a deeper tension between the safety and soundness mandate of the Fed as a bank regulator and the mandate of the Fed as an administrator of monetary policy?
I would say no, and I'll tell you why. Interest rate risk is, one of the most basic banking risks. We supervise for it. Overwhelmingly, U.S. banks did manage their interest rate risk. Silicon Valley Bank didn't, and even though we were, the supervisors were pointing that out to them, they just didn't take, the bank didn't take action quickly enough. So I would have thought that you can say that it was interest rate hikes that caused portfolio losses, but it was management that failed to hedge against those losses and failed to hold appropriate liquidity.
In the pre-COVID world, we had the best of both worlds, low unemployment, low inflation for decades. Do you believe that we could return to that best of both worlds, or are high interest rates a new normal in the American economy?
So we will return to 2% inflation and maximum employment. What will be the level of interest rates there? That's a really good question. And
do you suspect it's going to settle at a higher level than we've known historically?
I think it's really hard to know. It's a great question. We talk about this a lot. The people who argue that they will move it back down just point to the fact that it was really global factors that drove rates down in the first place. Maybe the truth is somewhere in the middle.
The gentleman's time has expired. The gentleman from Nebraska, Mr. Flood, is recognized.
Thank you, Mr. Chairman. Chairman Powell. I'd like to discuss the continued efforts to unwind years and years of quantitative easing and what it's done to our Federal Reserve balance sheet. If you take a look at the size of the Federal Reserve's balance sheet since the 2008 financial crisis, we've seen an alarming increase from around $800 million to today's $8.3 trillion in assets. Back in 2018, you did start the work of winding down the balance sheet. You managed to offload roughly $700 billion assets between the beginning of your time as Federal Reserve Chair and August of 2019. The problem was, shortly after your efforts began, we had another major economic shock, the COVID-19 pandemic, that caused the Fed to once again return to quantitative easing as a form of economic relief. Pretty soon, the Federal Reserve's balance sheet had increased another $4 trillion in size. That's how we made it to the balance sheet level that we are at today. I understand you have started working to shed some of the Federal Reserve's balance sheet, and I appreciate the work. That being said, the scale involved here, to me, is startling. My concern, Chairman Powell, is that efforts to shed assets from the Fed's balance sheet have never been anywhere as quick as efforts to build it back up. Our economic cycle does go through recessions from time to time. It's not always boom, but some bust too. If we continue a pattern of rapidly building up the Federal Reserve's balance sheet in bad times and slowly shedding assets in good times, we're going to see the balance sheet grow significantly over time. Chairman Powell, is this a concern of yours? And to pair with that question, long term, how can we avoid an environment where any effort to unwind the Federal Reserve's balance sheet is undone anytime there's an economic shock?
It is a concern, and that's why we are this time the balance sheet roll-off is much faster than it was back in the first episode. We also know more. We hadn't grown our balance sheet like that, and we hadn't shrunk it before. Now we have experience with that. So we are moving back down to a level that will be appropriate for our new framework. By the way, we won't go back to a framework where we were dealing with scarce reserves. We like the administrative rate framework that we're in now. But it is important that the balance sheet not just grow with every cycle, and I think I'm very conscious of that.
Chairman Powell, do you have an optimal Fed target for the size of what the balance sheet should look like? A number?
I'll give you the idea, and that is, you find the number, but the idea is that it's smaller than now. It's a place where reserves are abundant, and also have a little bit of a buffer on top of that so that we don't accidentally run into reserve scarcity. Demand for reserves can be volatile, and you don't want to find yourself, as we did a few years back, suddenly finding that reserves were scarce, even though we didn't see it coming, and we then had to put more reserves into the system at a time when we didn't want to be doing that. So I think you want to have a level where we have ample reserves plus a buffer, and that'll be a percent of GDP that we get down to, and we're moving in that direction pretty smartly.
Chairman Powell, realistically, how quickly can the Federal Reserve unwind its balance sheet? What's the threshold beyond which an asset sell-off by the Federal Reserve would disrupt our markets?
So we don't sell assets. What we do is we allow them to mature and passively roll off, and that's what we're doing to the tune of about $1 trillion a year. And we're in the middle of that process. Now we will, it's an empirical question, you're going to find a level that is still ample, plus a bit of a buffer, and that's how we're thinking about it.
Thank you, Mr. Chairman. I would just reiterate my concern on this issue. I fear that having the Federal Reserve backstop so much of our economy through the holding of treasuries and mortgage-backed securities is not sustainable long-term. Thank you, Chairman. I yield back.
Gentleman yields. The gentleman from New York, Mr. Horsford, or Nevada, Mr. Horsford is recognized.
I thank the chair and the ranking member for holding this important hearing, and thank you, Chair Powell, for appearing before the committee today. Before I begin, I'd like to ask permission to enter into the record editorial by the Las Vegas Sun entitled "Economy Infrastructure Thrive When Dems Have the Reins," dated June 16, 2023.
Without objection.
During this time of increased economic uncertainty, it is more important than ever that the Federal Reserve fulfills its dual mission of maximizing employment and supporting price stability. There is no doubt that it is difficult, and the needle that has to be threaded is very specific. However, the human cost is simply too great for us to get this wrong.
Sometimes we need to be reminded that there are real people behind the economic data and that the actions taken by both Congress and the Fed have real consequences for everyday Americans. Everyday Americans who want to know that myself and my colleagues are dedicated to creating an economy that actually works for them, which is why I was pleased that last week the Federal Reserve decided to pause your interest rate hikes and take stock of the overall economic picture. Now, don't get me wrong, there's certainly more work ahead of us, but with 13 million jobs added since President Biden took office, we should be rooting for America to succeed and not to fail. The strength of the labor market continues despite the multiple concurrent shocks that continue to reverberate throughout the global economy. And I believe our economy remains resilient thanks to the historic investments that were included in the legislation passed last Congress and signed into law by President Biden. These beneficiaries of these investments were the people, the middle class, not special interest. The bipartisan infrastructure law is creating construction jobs and projects that will help ease supply chain challenges and ensure safer transportation for everyone. President Biden and congressional Democrats are investing in technology that will define the 21st century, components to generate solar and wind energy, semiconductors and electric vehicles that will all be made here in America. Just last week, Treasury Secretary Yellen was before this committee and described how the transformational investments from the Inflation Reduction Act are ushering in a renaissance of domestic manufacturing. These are good-paying jobs, union jobs, that are expanding our production capacity here at home while reducing our reliance on goods imported from abroad. As I indicated in the editorial by my hometown newspaper, the Las Vegas Sun, remarks that annual investments in manufacturing construction has more than doubled its pre-pandemic levels. Furthermore, when we narrow the focus to the region, including Nevada, the U.S. Census Bureau estimates that in just 2 years, private manufacturing construction increased almost tenfold. So if we want to rebuild the American middle class, we must do so from the middle out and by investing in modern infrastructure and modern manufacturing facilities. But this does not mean that everything is improving equally. I've heard time and again from my constituents about the cost of housing being one of their biggest pain points. The Monetary Policy Report points out that housing services prices have risen a shocking 8.5% over the 12-month period ending in April, and in my district, it's even worse. So Chair Powell, at a time where it has become increasingly difficult for working Nevadans to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a house provides. While higher rates have cooled some housing markets across the country, what do you see as the biggest remaining upward pressure on housing services, and what can we do in Congress to incentivize new home starts to hopefully moderate the imbalance between supply and demand in the housing market?
I think you're talking about largely longer run factors here, and I think there has been for some time a shortage of housing. It's harder to get lots, it's harder to get workers, and in the pandemic it had been harder to get materials and things like that. So there's certainly a need for more housing. I think during the pandemic you had people wanting to live in houses rather than downtown in apartments because of COVID. You had low rates, and so you had 2 or 3 years of very, very high price increases for housing, and now that is flattened out a lot as we've raised rates. And
Gentleman's time has expired. The gentleman from New York, Mr. Lawler.
Thank you, Mr. Chairman. Chairman Powell, you, the Fed's Vice Chairman for Supervision, and many others have indicated that the banking system is well capitalized. Bank capitalization remained robust during the COVID shock and related shutdowns of economic activity and in severe Fed stress testing. Nonetheless, the Vice Chair for Supervision wants to increase capital and other requirements on financial institutions. This will have substantial economic effects that will begin immediately while you are still focusing on bringing inflation back to the Fed's 2% target. Excessively high capital requirements will constrain credit provision to the economy, costing jobs, incomes, opportunities, and living standards. As my colleague Mr. Garbarino pointed out, a 1%